push the commodities price higher. Yet the overall environment for the oil market seems to be characterized by a wider uncertainty. In this report, we aim to shed light on the factors driving WTI's price and assess future outlook. We make a start, as always, with the data describing the situation on the ground over the US oil market over the past week. At the end of the past week, the Baker Hughes oil rig count indicated that the number of active oil rigs in the US had increased by 1, which, despite being minimal, is still a positive sign given the continuous reduction over the summer. On the other hand, through both the API as well as the EIA reported substantial increases of US oil inventories, with the first reporting an increase of 1.174 million barrels and the second of 3.954 million barrels. The last data displayed exactly the inability of the US demand side of oil to catch up with production levels, thus implying that the tightness reported over the past few weeks in the US oil market may have cracked. We expect that should the agents report even wider increases in the coming week as well, the data of the US oil market may start weighing on oil prices, as it would imply that easing of the tightness widens. Market worries for the demand side of the international oil market seems to be maintained, albeit the prediction seems to have started to change. The IEA market report for September states that world oil demand remains on track to grow by 2.2 MB/d in 2023 to 101.8 MB/d, led by the surge in Chinese consumption, jet fuel and petrochemical feedstocks, which tend to provide a positive note. Also, OPEC stuck to its forecasts for robust demand growth in global oil demand for the current and next year. Yet at this point, we must note that the Chinese factories seem to continue to struggle to expand to increase economic activity. We would highlight the release of China's industrial output and urban investment growth rates, both being for August and due out in tomorrow's Asian session. Should the data imply an expansion of economic activity, then we may see oil prices getting some support and vice versa. On the other hand, we note that the inflation in the US economy tends to remain rather stubbornly high according to the CPI rates for August that came in hotter than expected. Such a development may force the hand of the Fed to keep rates high for a prolonged period, with the cumulative effect having an adverse effect on economic activity and thus oil consumption in the US. On the supply side of the commodities trading, we highlight the IEA mentioned that the production cuts of Saudi Arabia and Russia, which are to be extended to the end of 2023, will mean a substantial deficit in the oil market through the last quarter of the year. For the deficit to overturn in the next year, the oil production cuts may need to be ended, and that may not be the case. It's characteristic that Saudi Arabia is able to charge already US $100 per barrel for its oil, despite other grades of oil such as Brent and WTI being traded at lower levels. The premium charged by the Saudis to European and American customers primarily, who want to avoid Russian oil, tends to allow for a vacuum that may allow oil bulls to advance further in the coming days despite any possible hesitation. Thank you for watching.